Hi guys, I'm Phoebe. Welcome back to my channel. In today's video, we're going to talk about WACC. We're going to explain what it is, why we need it, and at the same time, how can we find each component of WACC. Let's get started. So when we are considering to finance the assets of a company, for example, if firm A want to finance its asset of 100 million US dollars two ways. It can either borrow money from others or attract investment from others. So if firm A want to borrow money from the government may require firm A to pay interest instead. So there is borrowing cost for firm A when it borrows money from others. So this cost of borrowing is actually called cost of debt. Here is the reminder. Here, the cost of debt is pre-tax cost of debt. As we know, the interest paid for debt is tax deductible. So we multiply this debt by 1 minus t. We call this tax shield. T here refers to the tax rate, and we can always find the tax rate from a company's financial statements. Investors, when making investment, usually look for a future return. So the minimum rate of return investors expect to get from this investment is called a cost of equity here. Cost of equity. As the equity side is not tax deductible, we don't need to multiply by 1 minus t. Sometimes a company may encounter preferred stock. Preferred stock is something between debt and equity. Preferred stock has higher priority when company is facing liquidation, and at the same time, it has higher priority in terms of receiving dividend. In terms of the cost of preferred stock, it's normally calculated by the dividend divided by the market value of preferred stock. In today's video, we'll focus more on equity and debt. And as we can see from this equation, there is a term in front of cost of equity, in front of a cost of debt, and a cost of preferred stock. These are actually weight of equity, weight of debt, weight of preferred stock in the whole firm's value. For example, if I have 10 million borrowed from the government, 90 million raised from investors, the weight for equity is 90 over 100, and at the same time, weight of debt is 10 over 100. Well, after understanding the meaning of WACC, why we need it? Well, if we want to value a company, normally we make projections on company's free cash flow. For example, just assume today is like the end of 2024, and this free cash flow is calculated for the end of 2025. This is for the end of 2026, etc. If we want to find the value of the company at today, we cannot just simply add all these free cash flows. Instead, we need to discount all this value back to today. So it should be free cash flow 2025 divided by 1 plus the discount rate. Here, the discount rate is actually WACC. And then for the next one is FCF 2026 divided by 1 plus WACC square. And we can plus other corresponding free cash flows. So WACC is used for discounting all the future free cash flows back to find the value of the company today. Now let's have a look at how can we find each component of WACC. So for the debt component, normally we aim to find the market value of debt, and this piece of information is usually on the balance sheet. Or you can search website to see if any information is released by the company. Let's take Apple as an example. As we can see, this is Apple's financial statements, and we can go to the balance sheet part. Here is the balance sheet, and we can see on balance sheet there is the liability side, and we can see this commercial paper, term debt. And by seeing the financial statements, especially the balance sheet, we can have an information of the book value of that. Keep in mind, it's important for us to find the market value. So if we want to find the market value, we may go to notes of each statement here. After the financial statements, there is a note regarding that. We can find more information about market value of that from its notes or from its other released sources. If we cannot find the market value, we sometimes use the book value as an approximation. So this is for finding that component. Now let's move to equity component. Equity component is actually the total market value of common equity plus non-controlling interests. Let's look at them one by one. For common equity, this is relatively easy to find. We can directly search websites like Yahoo Finance. It is the information for Apple. And we can directly find the market cap from Yahoo Finance. Market cap is just a share outstanding multiplied by share price. And another term is non-controlling interest. So what is non-controlling interest? Let's assume there are company A and company B. If company A owns more than 50% of company B's share but smaller than 100% of company's share, we say company B is a subsidiary of company A. Here is a subsidiary of A. So if company B is a subsidiary of company A has ownership on company B and can make decisions for the company B. So we need to put company B's information in the financial statements of company A. For example, if company A owns 80% of company B, we need to consider the rest of 20%. The rest of 20% is not owned by company A, it's owned by other investors. So company A need to mention this 20% of share in its balance sheet as a non-controlling interest. This piece of interest is not controlled by company A. Now, after explaining how can we find equity and debt, let's have a look at cost of capital. As we can see from this formula, cost of equity is equal to risk-free rate plus beta multiplied by equity risk premium. So how can we find each of these three terms? For risk-free rate, normally we consider 10-year government bond yield as a benchmark. However, as different countries may have different credit risk, we need to adjust the risk-free rate from the 10-year government bond yield by minus its default spread. If we consider a relatively turbulent country like Ukraine right now, for example, if 10-year government bond yield is 15%, we have to take the country's credit risk into consideration. So this default spread is actually the extra interest a country pays compared to a risk-free country. And in order to find what is this default spread, we can use this website. This website is composed by a professor in NYU. It contains default spread of different countries. So if there is a company running in Argentina, we have to minus the Argentina's default spread from its 10-year government bond yield. Now let's have a look at how can we find the levered beta. We cannot directly find levered beta because it's a bit difficult. So we start from the unlevered beta first. Unlevered beta only consider the business risk. So usually we may find online the unlevered beta of an industry in specific country. We assume that all the companies in this industry, in this country, they share similar unlevered beta. And then we use this unlevered beta to find the levered beta of specific company. As each company has its own capital structure. For example, some companies may have more debt than other companies. Some companies that a tax rate may be higher than other companies. So we reflect a company's capital structure by multiplying the unlevered beta by this term. As we can see, the higher the debt to equity ratio, the higher the levered beta. The higher the debt to equity ratio, the higher the financial risk from borrowing, right? We can already find debt, equity, and tax shield from previous example. How can we find the unlevered beta? Well, we can find the unlevered beta from this website. Here you can have the full Excel for different industry and different country. This web page is an example for sectors in US. As we can see, for advertising sector, the unlevered beta is 1.12. So if we want to find a levered beta of a advertising company in US, this advertising company has debt to equity ratio equal to 1/3 and tax rate being 25%. So if we want to find its levered beta, it should be 1.12 times 1 plus 1/3 multiplied by 25%, right? So this offers a relatively easy way for us to find the levered beta for a specific company. Now we have already found risk-free rate and beta, and it's time to find equity risk premium. Now let's have a look at equity risk premium. It can either be calculated by US equity risk premium plus country risk premium, or it's just weighted average equity risk premium. So we usually look at the revenue sector of a company. So when calculating equity risk premium of a company, we usually look at the revenue segment. For example, if a company gets 30% of its revenue from US, 70% of its revenue from China, then we look at the equity risk premium of US. For example, it's like 1.3 and the China is like 1.5, and then we just multiply 30% by 1.3 and 70% by 1.5, so we can get the equity risk premium of this company. By looking at where the revenue of the company comes from, we can get the weighted average equity risk premium of the company. Country risk premium is actually the extra risk for investing in a country due to factors due to political instability, inflation, or weak institution, etc. For example, the Chinese ERP is just equal to US ERP plus the country risk premium of China. And the UK ERP is just equal to US ERP plus UK country risk premium. As we can see here, for each country there is equity risk premium as well. So if we look at the example of Apple, we can search a revenue segment. Usually I type keyword like segment to see if there is any information related to its segment performance. After knowing the relative proportion of the revenue, we can get the weight of each revenue. We can multiply corresponding ERP, America, and then we can take sum of all these to get a weighted sum of equity risk premium. So this is Europe. So we can take sum of all these to get a equity risk premium of company Apple. Cost of debt is actually the long-term borrowing cost, as we mentioned before. We have two methods for calculating the cost of debt. The first is a direct bond yield. This is a relatively easy one. If a company offers information related to yield to maturity of its 10-year bonds, we can directly use this yield maturity as an approximation for the borrowing cost of the company. However, there are many cases in reality where you cannot find the yield to maturity of a company's 10-year bond. So we can calculate the cost of borrowing by this. We can first find the 10-year government yield, and then we should find the corporate default spread. This is related to the company's credit rating. The higher the company's credit rating, the lower the corporate default spread. This is easy to understand. For example, if there is company A and company B. Company A is credible, and company A's market capitalization, it's like 200 trillion, just for example. But company B is not credible, and its market cap is just like 1 million. It's a really, really small company. So if company A want to borrow money from me, I may require a lower interest rate, as I know this company is trustworthy and credible. It's unlikely to default. However, if company B want to borrow money from me, I may require a higher interest rate. That's why the borrowing cost for company B is higher. So we need to plus the company default spread in order to reflect the company's credibility. So how can we find the company's credit rating? There are many credit rating agencies like Moody's, S&P. We can always find their rating online, and then we can find the corresponding corporate default spread after knowing its rating. So for example, if we find that the credit rating of Intel is BBB+, we can use this website to find the corresponding spread based on this credit rating. Now let's have one final look at the formula. So WACC is the weighted sum of all these cost of capital sources. So this is cost of equity, after-tax cost of debt, and cost of preferred stock. So these three are the corresponding weights of equity, debt, and preferred stock. For finding the cost of equity, we use Kaplan formula, and for finding cost of debt is 10-year government yield plus the corporate default spread. And for cost of preferred stock, it's just dividend divided by the market value of preferred stock. So that's the end of today's video. Hope you enjoy it. See you in the next one. Bye.